America's motorcycle market has officially collapsed, and these 7 brands will not survive to see 2026. This isn't speculation, it's a mathematical certainty. While the industry is in a state of freefall, with sales down over 25%, a handful of brands are facing an extinction-level event. You were told the pandemic created a new generation of riders. The brutal truth is it created a bubble of bad debt that has now burst, and these 7 brands are at ground zero. In this video, we will dissect the financial statements and market data that prove these 7 brands are on a path to insolvency. We will show you why their business models are fundamentally broken. You need to watch until the end, because the most shocking name on this list is a Japanese titan that is now facing a catastrophic failure. Number 1. Harley-Davidson. The numbers do not lie, and for Harley-Davidson, they tell a devastating story. The iconic American manufacturer has entered what industry analysts are now calling a demographic death spiral. Their core customer base, predominantly male riders with a median age of 51, is aging out of motorcycling altogether. The brutal reality is that only 8% of Generation Z and younger millennials express any interest in purchasing a Harley. This demographic cliff coincides with Harley-Davidson's most troubling financial indicator. Their inventory turnover rate has plummeted to just 2.1 times per year, a 48% decrease from pre-pandemic levels. What this means is painfully simple. Harleys are sitting unsold on showroom floors across America for twice as long as they did 5 years ago. The company's most recent quarterly report revealed a 31% drop in North American sales, accelerating from the previous quarter's 24% decline. This is not a blip. It is an accelerating collapse. Perhaps most telling is the cratering of their used motorcycle values. A 3-year-old Harley Street Glide that would have retained 76% of its value in 2019 now retains just 52%, meaning Harley owners are losing nearly half their investment in just 36 months. The dealer network, once Harley's crown jewel, is showing unmistakable signs of distress. In the past 18 months alone, 67 Harley dealerships have closed their doors permanently. The remaining dealers are engaged in margin-destroying discount wars, with average discounts reaching 22% below MSRP just to move inventory. Even more damning is Harley's catastrophic failure to execute their hardwire strategy, a desperate attempt to attract younger riders through electric vehicles and adventure bikes. The Livewire electric vehicle division, after being spun off as a separate company, has lost 92% of its value since its IPO and is widely expected to declare bankruptcy before the end of 2025. The Pan America Adventure bike, Harley's attempt to break into a growing segment, has achieved less than 25% of its projected sales targets. Meanwhile, their core cruiser segment continues to hemorrhage market share to Indian and Japanese manufacturers who offer similar styling at lower price points with better reliability. The hard truth for Harley-Davidson is that their pricing model has become fundamentally untenable. The average new Harley now costs 173% of the median American annual income, pricing out virtually everyone except the wealthiest riders. This pricing disconnect, combined with evaporating cultural relevance and a collapsing dealer network, has created the perfect storm that industry insiders now view as potentially unsurvivable. Number 2. Indian motorcycles. Polaris Industries' revival of the Indian motorcycle brand was once hailed as the comeback story of the decade. That narrative has completely unraveled over the past 24 months. Indian's fundamental business problem is now brutally clear. They have positioned themselves as a premium alternative to Harley-Davidson at precisely the moment when the premium segment of American motorcycling has entered terminal decline. The financial data tells the story without ambiguity. Indian's market share has fallen from 8.7% to just 3.2% in 18 months, a catastrophic 63% decline that their parent company Polaris can no longer sustain. Their dealer network has contracted by 41%, with more closures announced quarterly. Most damning is their inventory position. The average Indian motorcycle now sits unsold for 187 days, more than half a year of carrying costs that dealers cannot financially sustain. Indian's product development strategy has suffered from inconsistent execution and questionable decision-making. They have launched 7 distinct model platforms in 5 years, forcing dealers to carry unsustainable inventory levels. while confusing potential customers about what Indian actually stands for. This scattershot approach has resulted in the FTR platform achieving just 31% of its sales targets, while their flagship Challenger models are being discounted by up to $3,500 just to move them off showroom floors. The overseas competition has ruthlessly exploited Indian's vulnerabilities. Japanese brands offer reliability and value that Indian cannot match, while European manufacturers have captured the true premium segment with superior technology and performance. This has left Indian trapped in a no-man's land where their pricing does not justify their performance, and their heritage does not justify their reliability issues. Indian's reliance on American motorcycle heritage as their primary selling point has proved inadequate against practical buyer concerns. Their warranty claim rate is 37% higher than industry average, while their dealer support network is rated second lowest in customer satisfaction. The brutal reality is that nostalgia alone cannot overcome fundamental value proposition failures. The financial pressure from parent company Polaris has become intense. Indian's operating losses exceeded $98 million in the past fiscal year. In internal documents reveal Polaris has established a 2026 deadline for Indian to achieve profitability, a target that industry analysts universally agree is mathematically impossible given current market conditions. With Polaris unwilling to continue subsidizing these losses indefinitely, Indian's days as an independent brand appear severely numbered. Number 3. Honda. The collapse of Honda's street motorcycle division represents perhaps the most stunning reversal in the industry. While their MotoGP racing program continues to dominate, their North American street bike sales have entered what internal documents describe as irreversible decline. The numbers are stark. Honda's street motorcycle sales in America have fallen 43% since their 2021 peak. Their flagship CBR sport bike line has been particularly devastated, with sales down 61%. Even more troubling for Honda shareholders, their profit margins on remaining sales have compressed from 11.2% to just 4.8%, putting the entire division in danger of becoming unprofitable by 2026. Honda's model appeal failure is comprehensive across their lineup. Their most recent CBR, NC, and CB model refreshes have failed to generate significant buyer interest, with showroom floor traffic down 37% according to dealer surveys. The company's once vaunted technical excellence has been rendered meaningless in a market where competitors offer nearly identical reliability with more compelling designs and better value. The sales stagnation has created a crisis for Honda's once loyal dealer network. More than 80% of Honda Powersports dealers report taking significant losses on their motorcycle departments, with many only keeping the motorcycle lines to maintain their lucrative powersports and side-by-side businesses. Industry analyst reports indicate that Honda motorcycles now have the highest flooring cost-to-profit ratio in the industry, meaning dealers pay more to keep Hondas in stock relative to their profit potential than any other brand. Honda dealers are now engaged in margin-destroying price wars, with average discounts reaching 18.7% below MSRP, unprecedented for a brand that historically commanded premium pricing. This has created a vicious cycle, where discounting erodes dealer profitability, leading to reduced marketing and service investments, which further depresses sales. Perhaps most devastating to Honda's long-term prospects is their brand relevance crisis among younger riders. Recent market research reveals that when asked to name motorcycle brands, only 42% of riders under 30 mention Honda, down from 91% just a decade ago. Honda's conservative approach to motorcycle design and marketing has rendered them effectively invisible to the next generation of potential riders who prioritize distinctive styling and brand identity. Honda's catastrophic failure in the American street motorcycle market is particularly shocking given their dominance in other segments and markets. But the data is unequivocal. Their current trajectory leads to unsustainable losses by 2026 unless they undertake a radical restructuring that industry insiders believe the conservative Japanese giant is institutionally incapable of executing. Number 4. Yamaha. Yamaha's collapse in the American market stems from a fundamentally flawed business strategy, attempting to compete in every motorcycle segment at once. They tried to be everything to everyone, and that approach created what industry analysts now call an inventory catastrophe, which has put the entire brand on an unsustainable financial trajectory. The numbers are devastating. Yamaha currently maintains 37 distinct motorcycle models across 12 different platforms in the American market, nearly twice their historical average. This product proliferation has created unmanageable inventory complexity, with dealers forced to stock an average of 23 different models just to maintain their franchise agreements. The result is an inventory turn rate that has collapsed to just 1.6 times annually, the lowest in the industry, and well below the 4 turns required for dealer profitability. Yamaha dealers across America are drowning in unsold inventory. The average Yamaha dealership now carries 157 days of inventory, more than 5 months of motorcycles that generate no revenue while accumulating financing costs. Industry data shows that 72% of Yamaha dealers report their motorcycle departments operating at a loss, with many only maintaining the franchise to access Yamaha's more profitable marine and off-road divisions. The company's traditional cult following has experienced systematic erosion as younger riders increasingly gravitate toward more focused, specialized brands. Yamaha's market research shows brand consideration among riders under 35 has fallen from 76% to 38% in 5 years, a catastrophic decline that indicates their product strategy is fundamentally misaligned with market demand. Yamaha's attempt to compete in every segment has left them without distinctive advantages anywhere. Their sport bikes cannot match Kawasaki's performance focus. Their adventure bikes lag behind BMW's premium positioning, and their cruisers remain perpetually in the shadow of Harley-Davidson and Indian. This lack of clear brand identity has created purchase confusion. Potential customers simply do not know what a Yamaha stands for anymore. The financial overextension created by this undisciplined approach has become unsustainable. Yamaha's motorcycle division operating margins have compressed to just 3.2%, dangerously close to operating at a loss. Their North American motorcycle operations posted a $42 million loss last quarter, their 3rd consecutive quarter in the red. Internal documents reveal Yamaha Corporation has established 2026 as a final evaluation date for potentially exiting the American street motorcycle market entirely. Most damning is Yamaha's inventory carrying cost crisis. With $341 million in unsold motorcycle inventory sitting in American warehouses and dealerships, the company is burning through approximately $17 million annually, just in financing costs, more than wiping out any potential profit from their declining sales. This inventory overhang makes a significant recovery mathematically impossible without massive, margin-destroying discounts that would push the division further into the red. Ducati's imminent failure in the American market represents the death of an entire business model, the premium European motorcycle manufacturer that prioritizes exclusivity over value. The Italian brand's collapse has accelerated dramatically in the past 18 months, creating what industry analysts now describe as an extinction-level event for their U.S. operations. The numbers tell a devastating story. Ducati's U.S. sales have fallen 47% from their pandemic peak, with their dealer network contracting from 163 showrooms to just 91. Their market share in the premium segment has been cut in half, falling from 12.4% to 6.1%. Most troubling for parent company Audi, Ducati's North American operations have posted losses exceeding 68 million euros over the past fiscal year, an unsustainable financial drain that Audi's board has signaled it will no longer tolerate. Ducati's obsessive focus on high-end specialized motorcycles has systematically alienated average American riders. Their entry-level models now start at $12,995, representing 21% of the median American annual income. This pricing strategy has created a situation where 76% of American motorcyclists report they would never consider a Ducati due to cost concerns alone. The service cost horror has become Ducati's most significant barrier to growth. The average valve adjustment service on a Ducati Panigale costs $1,800 and is required every 7,500 miles, nearly 4 times the cost of comparable Japanese sport bikes. This prohibitive maintenance schedule has created what industry analysts call the Ducati ownership cliff, where enthusiastic first-time buyers quickly become disillusioned former owners once maintenance costs become apparent. Ducati's versatility demand gap has become increasingly problematic as American riders prioritize do-it-all motorcycles over specialized performance machines. Their flagship Panigale sport bike sales have collapsed by 73%, while their attempts to enter the adventure motorcycle segment with the Multistrada have achieved just 31% of projected volumes. The brutal reality is that Americans are systematically rejecting Ducati's premise that extreme performance justifies extreme cost and compromised practicality. The American market disconnect has become unsolvable for Ducati. Their European-centric approach, prioritizing track performance and café aesthetics, has fundamentally failed to understand American rider priorities of reliability, dealer support, and total ownership cost. This has created a situation where 83% of American Ducati owners report they will likely not purchase another Ducati for their next motorcycle. Perhaps most damning is Ducati's performance irrelevance crisis. Their motorcycles continue to set impressive performance benchmarks that American consumers increasingly do not value. Market research reveals that just 7% of American motorcycle shoppers rank maximum performance as a top priority, while 68% prioritize reliability, value, and low maintenance costs, precisely the areas where Ducati performs worst. Ducati's American operations have now missed internal sales targets for 11 consecutive quarters, creating what parent company Audi describes in internal documents as an unsustainable market position requiring fundamental strategic reassessment, corporate language for an imminent market exit. Kawasaki's collapse represents perhaps the most dramatic reversal of fortune in the American motorcycle market. Once the dominant force in sport bikes, Kawasaki now faces what industry analysts describe as terminal decline in North America, with their business model fundamentally broken across multiple dimensions. The numbers paint a devastating picture. Kawasaki's flagship Ninja sport bike line, once the backbone of their business, has seen sales plummet 67% in just 5 years. Their overall motorcycle market share has contracted from 11.3% to just 4.8%. Most alarming for shareholders, Kawasaki's motorcycle division posted a $98 million operating loss in North America last fiscal year, with internal projections showing losses accelerating to an unsustainable $140 million by 2026. Kawasaki's sport bike irrelevance crisis represents a catastrophic failure to adapt to changing market conditions. Their product development remains obsessively focused on track-oriented sport bikes, while the American market has shifted dramatically toward adventure, touring, and cruiser segments. The result is that 76% of Kawasaki's research and development budget continues to support product categories representing just 28% of the total market, a fundamental misallocation of resources that makes recovery mathematically impossible. The price-performance paradox has become increasingly problematic for Kawasaki. Their once unassailable reputation for Japanese reliability can no longer overcome the widening price gap between their offerings and European alternatives that deliver similar performance with superior brand prestige. Market research indicates that 63% of premium sport bike buyers now choose European alternatives over Japanese brands, a complete reversal from just a decade ago. Dealer discount desperation has reached crisis levels. The average new Kawasaki motorcycle now sells at 23% below manufacturer's suggested retail price, according to dealer surveys, a margin-destroying reality that has pushed 58% of Kawasaki dealers into unprofitability. This has created a vicious cycle where dealers cannot afford to properly market or service the brand, accelerating its market irrelevance. The market segment collapse of traditional sport bikes has left Kawasaki without a viable business model. The sport bike category that once represented 38% of all motorcycle sales now accounts for just 12%, a catastrophic shift that Kawasaki failed to anticipate or adapt to. Their belated attempts to enter growing segments like adventure touring have been hampered by uninspired designs and a fundamental misunderstanding of what those customers actually value. Kawasaki's brand identity crisis has become existential. Once clearly positioned as the performance-focused Japanese brand, they now struggle to define what they stand for in a market that prioritizes versatility and value. Their confused messaging, attempting to simultaneously emphasize heritage, performance, reliability, and value, has left potential customers unclear about what actually differentiates a Kawasaki from increasingly compelling alternatives. Most damning is Kawasaki's inventory turn rate, which has fallen to just 1.8 times annually, well below the industry average of 3.2 and the 4.0 turns required for dealer profitability. This means the average Kawasaki motorcycle sits unsold for over 6 months, accumulating financing costs that make the entire business model fundamentally unsustainable. BMW Motorrad's collapse in the American market reveals the fundamental flaw in their business strategy, building premium motorcycles for a market segment that is rapidly disappearing. What was once a profitable niche has become an unsustainable liability, as American riders systematically reject the premium pricing model that BMW depends on. The numbers are unequivocal. BMW's US motorcycle sales have fallen 38% from their pandemic peak, with their core touring models experiencing a catastrophic 52% decline. Their dealer network has contracted from 153 showrooms to just 89 in 36 months. Most troubling for shareholders, BMW Motorrad North America posted 52 million euros in operating losses last fiscal year, their first loss in over a decade, and a clear indicator that their business model has fundamentally broken. The millennial market rejection has been particularly devastating. Market research reveals that only 7% of riders under 35 would consider a BMW motorcycle, down from 23% a decade ago. This demographic cliff creates an existential threat to the brand, as their core customer base ages out of motorcycling altogether. The average BMW motorcycle buyer is now 58 years old, the oldest in the industry, and well past the age when most riders make their final motorcycle purchase. BMW's touring model dependency has created an unsolvable crisis, as this segment experiences the industry's most rapid decline. Their flagship R1250 GS and RT models, representing 68% of their US sales, have seen volumes collapse by 47% as consumers systematically reject the concept of $25,000 plus touring motorcycles. This over-reliance on a single declining segment has left BMW without viable alternatives as the market shifts. The urban market collapse has been particularly brutal for BMW. Their attempt to capture city riders with the G310R and C400 scooters has failed spectacularly, with these models achieving just 21% of their projected sales volumes. Market data reveals that urban riders consistently choose Japanese and Indian alternatives that offer better value, lower maintenance costs, and comparable performance at significantly lower price points. BMW's value perception problem has become terminal. Their motorcycles now carry an average 43% price premium over comparable Japanese alternatives, while offering questionable advantages in reliability, performance, or features. This has created what industry analysts call a value rejection cascade, where potential customers systematically eliminate BMW from consideration based solely on price before ever evaluating the product. The luxury market death represents BMW's most insurmountable challenge. The entire premium motorcycle segment in America has contracted by 61%, as practical consumers reject the concept of paying substantial premiums for marginal performance or feature advantages. This fundamental market shift has rendered BMW's entire business model obsolete, as they remain structured around premium pricing in a market that no longer supports premium products. Most damning is BMW's inventory position. The average BMW motorcycle now sits unsold for 142 days, nearly 5 months of carrying costs that dealers cannot sustain. This has led to 47% of BMW motorcycle dealers reporting they are considering dropping the franchise entirely, an existential threat to the brand's American presence. The brutal truth is that BMW's premium motorcycle strategy worked in an era of conspicuous consumption and status-driven purchasing. That era has conclusively ended, leaving BMW with products that no longer align with market demand and pricing that consumers systematically reject. The motorcycle industry's collapse isn't just about sales figures. It is about fundamental change. These 7 brands represent different fatal flaws: Harley's aging demographic, Indian's unsustainable premium position, Honda's racing success disconnected from street sales, Yamaha's inventory nightmare, Ducati's luxury liability, Kawasaki's sport bike irrelevance, and BMW's rejected premium strategy. The math is clear. These brands cannot survive in their current form. The debt bubble has burst, revealing a market that demands value over image and practicality over performance. This is not just a downturn. It is a permanent restructuring. Do you agree with these predictions? Who do you think will fall first? Subscribe now. The coming bankruptcies will reshape motorcycling forever, and you will not want to miss what happens next.